get started. All right, great. Hey, welcome today to our Understanding Your Financials monthly webinar from Ranch Right LLC. I am super excited that you guys are all here. I am also very excited about our topic. And one of the reasons I'm excited about our topic is, I'll be honest, this is not something I am very comfortable with. I get comfortable through most things by doing, not by reading about them. And frankly, debt is something I have worked for years to kind of avoid. I play a little bit with debt, but I don't use it a lot. And as we work at helping clients, oftentimes one of the things that we need to pay attention to and really manage is debt service. So Walter has tons of experience with this, fortunately. And so I am really anxious to hear what he has to say. As many of you know, I've introduced Walter here many times. He has been a wonderful part of our company and contributes, as you know, really developed most of the processes that we use and gave us the groundwork for putting together a ranching for profit style accounting system in real accounting software, and has been involved with that for decades, and brings a tremendous amount of experience to this. And I am very, very glad for the friendship that Walter and I have had for a long time. And I'm some days amazed at what I've learned. So Walter, with that, let's go ahead and talk about debt service. And I think it would be very important at the beginning. Let's talk about some definitions and clarify kind of what we are doing when we talk about debt service.
Right. Okay. All right. Can you let me share screen?
You bet.
Okay.
Does it not give you that already?
Okay. Let me go open it up.
Also, while he's doing that, a number of people have commented that in past videos, the viewers have not been visible, or they've covered maybe some of the on-screen content. And I am trying to figure out how to not have that happen. So I think I've got that done by eliminating the picture of everybody that is on the video. So if you watch the recording of this and it appears that it's covered, please let me know.
What's going on here?
I'm going to pause our recording for just a minute. Yeah, there you are. All right, we're back to recording. Keep going, Walter.
Okay, now let me make this a little bigger so that you guys can all see it. Okay. Okay. What we're trying to do here today is, you know, we've done prior events where we've talked about working capital, and we've talked about, you know, the ratios of our current, you know, say the current assets, current liabilities. We've talked about, you know, debt ratios and what some of the drivers are. But let's just think about when we go in and we have a chat with our loan officer from Farm Credit or you know, whatever bank that we're dealing with. They want to have some comfort on that you're going to be able to repay any borrowings that you have out there. Okay. And the debt coverage that we're talking about here, this primarily relates to, say, our I'm going to say our long-term debt. And when I'm talking about long-term debt in this context, I'm talking about, say, I mean, some of you, if you've been with Farm Credit or some of the banks will say, well, your intermediate debt and your land debt or whatever. But for what we're trying to do here today is we're trying to do where the intermediate and the land debt are what we're going to consider long-term because it's more than a year out. Okay. So,
And it's important, Walter, in our financials, we do not distinguish intermediate debt.
That's correct.
You can get to it, right, to fill out the form for the bank. That part's not hard, but it is either current or it is not current.
Yeah.
Current means it's 1 year, like an operating loan. Not current means it's anything longer than that.
Right. So what we're really trying to come up with here is when we have to make that commitment to the bank, how much do we have to cover our payment? And they're going to look at it from our history, and they're going to look at it as we plan out something for maybe adding a new enterprise. Is that enterprise going to generate enough cash flow to make that debt service? Okay. So what we're really trying to do is we're thinking about, when I'm talking about debt service, I'm really talking about, say, the principal and interest that we're going to have for that, say, I'm going to call it the term loan. Okay. Does that make sense? Okay. All right. So there's some really great resources that are out there, and maybe some of you have there's a planning tool that comes out of University of Minnesota that sometimes some people in the ag finance actually use, and so I'm going with a little bit of where I think some of it is called FinPack. I know there's one young man that when he was in Wisconsin, he became very familiar with the FinPack software. Okay, so now one of the things I want to go down through this is what you're really trying to do is to figure out how much do we have available to pay the debt. But we have to make some, some of it we're going to have to make some adjustments to actually figure out where we are. So let's just say, for the sake of argument, I know John and Daniel and the John's team. I want to make a point here. So I'm really looking at that, maybe that some of the say the family living or the personal or the personal that is on that a family, a ranch family or farm family is taking out. I'm going to make a comment here. I just want to make sure I'm showing you why we're doing things. But the way, wait a minute, let me shut the phone off there. But what I'm trying to say is Daniel and John and the team actually have the family living. If it's a sole proprietor, they actually have it as an expense in the overheads or in other expense. But for what we're doing here today, I want to show you that we're actually making that as an adjustment here, just as a teaching point to make sure that we've got it covered. Okay. So what we're doing here is we're actually taking John and the team does everything on an accrual basis. So we're looking at, accrual being on a production basis. So, what is that driver that's the driver of how we're going to pay our debt back. So what I've got here is I've got really four different examples I wanted to share with you. I'm going to call the first column, and the column D is more, I'm going to call it the simplified version of what when it comes to the debt. And what we're doing is we're not making a distinction between the term debt interest in the process, because what the G column here, where I say term debt coverage ratio, some of the lenders like to see, they're going to leave the total interest in as an expense, say your interest on your operating, and they want to see how much you have available in order to pay that long-term debt that we were talking about. So that's really the difference between column D and column G. Does that make sense, John?
Makes sense to me. I want to make sure that, let's open that up a little bit. Just give a second for. Anybody got a
You just want
question?
to repeat that again?
Yeah,
Column D and column G?
yeah. The difference between D and G, Daniel, is that in D, the first column with the numbers, it has all of the interest in it, whether it is on operating or whether it is on a long-term debt. Where in column G, we're leaving the interest on the or say the short term, the debt that's, say on a line of credit, we're leaving it in as an expense, because what we're trying to see is to see how much we have available after we've paid that operating debt interest to go and make the payment on the term debt. Okay, that's the difference. Okay.
And I'd just ask real quickly, Walter, why would a bank want to do it one way versus the other?
Some of it is how they've been, because some of them like to focus more on the longer term debt. That's the main reason. Okay.
And so as you go between different financial institutions, they all have a slightly different focus. They have different strategies. They have different operations.
Right. And a lot of the extension and university ag finance people, they do it where they segregate the two interests. Now, right. a lot of more, I'm going to say commercial lines, or say commercial. I mean, let's say that you had a commercial loan officer that was, he's a good loan officer, but he would probably be doing stuff that would have, all of the interest in there versus what maybe where if it was somebody that had been with Farm Credit, they're going to be looking at it as in column G. That's probably a really good example.
Okay. And again, from a borrower's standpoint, my interest, frankly, is more in along the lines of column D, right? Because I got to pay all of it back at some point.
Well, yeah, and I mean, the University of Minnesota has a graph, and they basically mirror each other pretty close. I mean, they may be a little off, but they basically mirror each other. Okay.
Love it. Yep.
Okay. So. But anyway, well, I mean, okay, but what we're trying to do is let's just say, let's go down through this. We've got $80,000 of accrual income, a lot of depreciation there. The family living was 90,000. Okay, I mean, that is a separate item. It's not in the 80. Okay, we've got some income taxes that we're paying. And we've got $25,000 in interest expense. So we have $50,000 in order available. And that's what we're trying to do, is figure out what's available in order to pay our our debt repayment. Okay. And so what I'm trying to look at is, I have the star there, the two stars, and it's the scheduled principal on the term debt plus all of the interest expense. So did we have, in taking and dividing the 50,000 divided by the 48, it's only about 3% better. Okay, now if you're the loan officer, how do you feel about that? Grant, how would you, if you're talking to your loan officer, what's your loan officer going to think of that?
Probably not too good.
Okay.
It's not a lot of room for error, right?
No.
Right. So what would be something that a loan officer could maybe look to if he saw that 1.03? What would be something that the loan officer could look at? Any thoughts?
I'm going to just guess equity and real estate.
Well, that's one, but maybe we don't want to look at that. Okay.
Okay.
How about our existing working capital that we have?
Okay.
Okay. So I mean that's a possibility. Okay. And where we're coming from is, I think John, and John and the team are working on an app. But if you go down here and, say columns, whatever, 20, 21, 22, 23, that debt coverage ratio, when it's kind of, it's in the red when, or not a good mode if it's less than 1.25. So, John and I were working on another client the other day, and I was just kind of going through, some things in my head, and if you had to, I said we need to be looking at, the servicing ratio needed to be 1.5, and where I was coming from. So in that case, if you had 50,000, just to round things off, if you had 50,000 of debt repayment, then at 1.75, you'd want to be shooting for 75,000 available to pay the debt. Okay.
At 1.5. So you'd want the debt repayment capacity to be 1.5 times the debt repayment.
Right.
Yeah. Okay.
Got it. Okay. So that's why I did the red, yellow, green, just to give a little bit of context on what we should be shooting for. Okay.
So anybody not familiar, this is Alan Mullally's simple grading system. It's either bad, it's either marginal, or it's good. And if you're in the yellow, you want to be getting to the green.
Right.
And if you're in the red, you want to be getting out of that as fast as you can. So
Right.
Alan Mullally was the CEO of Ford during the big economic crisis. It kind of led them through a big transition, and ultimately led them to where they did not have to take federal funding during the financial crisis of 2008.
Right.
And his approach is very simple in that we break metrics down into these 3 categories, so we don't necessarily have to debate all the fine points. We just either decide if they're basically good or bad.
Right. That's correct. So what we're really doing is we're making a scorecard, and what's really positive is that when you start to track this over time, that's because what you're trying to do is you're trying to I've got some, like my college roommate who was a farm manager and, worked for a bank way back when. He's got spreadsheets, or say graphs, that he goes and he talks, and he lays it out when he goes in to see his bank about his, it's maybe his debt to asset ratio and his net worth, et cetera. So, It's trying to help, help the banker to understand, visually what, what his picture is over time. Okay. So. Okay.
Before we go ahead, sorry, somebody have a question?
Oh, go ahead. Go ahead.
ahead.
John, Walter, is that your ratio there? Is that the same as like a debt to net worth ratio, or is that slightly different?
No. Yeah, this is this is more the ratio that we're talking here is this is really how much cash do I have to actually go and cover my debt payments that I'm going to make. Yeah, I'm not really looking at anything net worth wise or anything like that in this particular case. Okay.
And Grant, that's a great question. And I'm going to claim, and Walter, you can argue against or for this. We actually haven't talked about this before. I am much more pragmatic when it comes to this thing than that debt to asset ratio or debt to net worth ratio, because to my mind, this is literally dealing in, do I have the cash, or is there a good probability I'm going to have the cash to actually pay the bill? And the bill is the annual payment on the debt. There are a lot of ways to manipulate debt to asset ratios, debt to net worth ratios, those sorts of things. The most practical consideration I have at the due date of the loan is, do I have that money? And I think, again, with low interest rates, with high interest rates, with different payback terms, that sort of thing, you can really get into the weeds and make those numbers say different things. But if I can't write the check at the due date, that's when I'm in a bind.
Right.
Does that make sense, Grant?
Right. That's
so,
right.
Yeah.
So Caleb, you ask a question here that is good, and it is much more similar to a debt to cash ratio. It's still not quite that, right? Because our accrual income at the bottom of our P&L is not quite that. Walter has adjusted it back, so it's a lot more like a debt to cash, but it is literally just your payment to cash. And again, we're not differentiating between principal and interest and those sorts of things like we do with a current portion on the balance sheet. We are taking the whole of the payment.
Mm-hmm.
Okay, now let me back this up just a little bit. If we've answered those, and if there are more questions on that, I really would like to talk about them. But I want to make sure everybody understands that we are looking in this first column. We are looking at a place where, and I always get lazy when I say this, the profit, we often talk about is the oh my goodness, why have I just lost my train of thought here? We talk about profit as the ability to, gross margin. Let's go back to that. That our gross profit, or our gross margin in ranching for profit terms, is our money to pay overheads and create profit. Mm-hmm. The third thing in that is to service debt. So really, when I say that our gross profit on our P&L, or your gross margin in ranching for profit terms, that is the money available to pay overheads, to service debt, and to generate profit, because debt service is done essentially out of profit. Walter, would you agree with that?
That's correct.
Okay. I've had a number of questions here recently about the fact that that we don't get to deduct the principal portion of our debt payment. And that is correct, because when we borrow money, we get to deduct the expenses that are used in that borrowing. So we can't double dip there. It's just, you get one shot at the deduction, and the deduction usually comes when the expenses occurred, which means that you do not have the ability to deduct that when the repayment happens, because that's essentially two transactions, if you will, that are one expense. So if that makes sense, and if we are very much focused on the sort of cash part of this, then again, being very pragmatic, there isn't a lot of room for interpretation here. Meaning if we do it this way, there are a lot of things here that keep us out of trouble. And I think when we stay focused that way, it makes things easiest. There are a lot of ratios, and there's one that I've just been discussing with Dallas. On the bottom of the financial summary, for example, there's like a long-term debt to short-term debt ratio. I don't really know what that means. But I know what it means when I can't pay my bills. And that's the part where we want to focus on so that we create the maximum opportunity for people.
Right.
Any other
Right.
questions or comments on that?
Okay.
Mimi in the chat put gross, Mimi, I assume you're doing this as a definition, which is gross income minus operating expense divided by the sum of all current debt. That is basically, and it's not just the current debt, it is just the payments on the current debt.
Right.
By current, I assume you don't mean current liabilities in the financial sense. You
No.
mean current like this year. And-
Right. Correct. It's what's due in 12 months.
Yeah.
Okay.
So when we look at a number that's like 3% above even, to my mind, you're a couple of pneumonia calves away from parity or not being able to pay that debt, right? In the
Right.
scenario you've given with 80,000 in accrual income, that's not a very big number. And there is not a lot of room for error. So this, when I talk about people where they say, "Ooh, we had a rough year and our preg rate was 80%, or our winning percentage was 87%, not 93, that more than would eat that 3%. Would you agree with that, Walter? All right, good. Hello, Wally.
Hello.
Okay, Tammy asked a question real quickly about, is this report available to us on QuickBooks? And it's a great question. Not exactly like this, but these numbers are very easy to get from the reports we give you.
Right.
And so the little spreadsheet, so let me just highlight a few things. This net accrual income that Walter has here is available at the bottom of your P&L, basically.
Correct. That's right.
For most of you, we are right now not including a depreciation expense. That's changing here this coming year, but we'll talk about that. And as he mentioned, we have family living withdrawals already included in that. We also have now income tax payments that are the part of the business included in that number. So really the bottom of your P&L is giving you the closest thing we can come up with right now for your repayment capacity. Then the total debt repayment, this is one I've actually been playing with working on. So we do a current portion right now with a lot of our customers, current portion of long-term debt that we add to our current debt or our current liabilities section. One thing Daniel and I have been talking about is essentially coming up with a current payments, which would split between the current portion of long-term debt and the interest portion. So you'd have both of those put together. We haven't gotten that finalized yet, but you would, if you took the current portion number off your balance sheet and added the interest to it, you would have that. In many cases, it's almost easier to just go through and add up what your payments are. So if you have an annual payment to FSA, an annual payment to Farm Credit, annual payment to the bank, just add up what the actual payments are. Sometimes that's the easiest way to get at that number. And then you just simply subtract the number at the bottom of your P&L, or subtract that payment number from the number at the bottom of your P&L. And obviously we are more than happy to walk through that with anybody that is interested in doing it in their own books.
Right.
Does that answer your question, Tammy?
Yep, that's great.
Perfect. Thank you.
Okay. So, as we go through this, another piece that, I wanted to kind of go through what's maybe another measure to look at this, but if we take the total term debt that's out there that we have on a client, okay, let's just say it was a $1 million, just for the sake of argument, and if we divide it by the earnings before the income tax and the depreciation, and maybe there's some amortization, and amortization I'm saying is, more, it's a, how we write off maybe a loan fee or something like that. So if you had $1 million and you had the earnings before the interest and the taxes and the depreciation was 250. If you divide the million by 250, it's 4. Okay, so that's a very kind of lower is better. Okay, but if you had $1 million and it was 500, or no, let's go the other way. Is if you were $1 million in term debt and you had say 800 in basically the EBITDA, okay. I mean, that's going the right way, but as that EBITDA goes up, okay, you want to make sure, because I mean, that's going to, I mean, when he gets up there where you've got, say, 100,000 of EBITDA, okay, and it's 10, that's going to be a struggle. That's the moral of the story. Okay, so you want to keep that, term debt to your EBITDA. You want to keep it under that 3.5, and that's David Cole is one that's written a lot about farm finance, and he's from Virginia Tech, and he consults on, I'm going to say, both sides of the aisle. I'm going to say he consults with Farm Credit and the bankers also. Okay, so that's what I'm talking about. Other other measures down there. That's another way to look at it. Okay, another one that Dave talks about also is, John and the team are always talking about working capital. Okay, and so when you divide the working capital, I mean, back to, let's say that you had somebody that had current assets over current liabilities of say $500,000, and you had your annual debt service was 100,000, then that's 5 to 1. So you really have 5 years worth of working capital to cover your payments. That's a very, very positive thing. Okay, so but if it was 500 and it was 250 was the debt service, 2 is not a good number. Okay, so I mean that's going to be a concern. Okay, so that's the scorecard there. One that you may
hang on one sec, Walter. Sorry to interrupt you. I want to make sure we go back. We've talked about working capital a number of times on this webinar. It is not the most commonly used metric, I think. So I want to make sure people understand it. We take the off your balance sheet, we take the current assets, which would include, money in the bank, stock or cattle, maybe your feed inventory, and we subtract the current line of liabilities, which for ease is oftentimes a line of credit and maybe some bills that are due currently, that sort of thing. And it is a dollar number. Current ratio, quick ratio, some of those things express a similar sentiment. But like other things, we prefer to deal with those in dollar numbers because they give us the ratios can be a little hard to interpret. The dollar numbers are very easy to interpret. And so,
That's correct.
so I put the definition in the chat. Again, working capital is just the current assets minus the current liabilities. And if we scale that number, we often do it in terms of days of operation.
Right. Right. Okay.
Okay. And the annual debt service you're talking about again is principal plus interest. So the total payments that you have to make.
Right.
Okay.
Got it. All right. Now, another one that's out there too is what they call a debt servicing ratio. So this is going to be your interest expense plus all your scheduled term debt payments, say your intermediate and long term, just for the sake of argument, and we're going to divide it by the gross product that we have on our RFP format financials. Okay, so a piece here is when that gets if you're in the University of Illinois has some data that they come up with, and you're in the bottom quartile if it's greater than 17%. And you're kind of in the yellowish if it's between 10 and 11, and if it's less than 5, you're back to being golden. So that's another way to look at this, depending on maybe a little bit of how you're wired. I mean, so that's another way to look at it too. Okay, John, that makes sense?
Yeah, I totally agree with this. Grant, I want to go back to your question before, because I think your question is foundational to how we understand how these work in a lot of different ways. This number makes me uncomfortable because there's a lot that can happen between the gross product and the bottom of the P&L, right? If you're a very low overhead business, your gross product and your net income numbers are going to be closer together. If you're a very high overhead business, then your gross product and the bottom of your P&L are going to be much further apart. I don't mind the ratios. I think these are things worth looking at. The first numbers that you looked at in my mind are my favorite because they talk in real terms that don't leave any room for uncertainty. Right. Now, I think from a planning standpoint and some others, look, and I think knowing that banks look at these numbers, debt service ratio is a number that you very commonly see in bank paperwork. Right. But that's a place where, again, as a practical, fairly simple person.
That's a very good comment. Yep. That's very good comment.
I like dollars. And if I know that I have $50,001 to pay my debt and it's 50,000, I'm sweating. If I know if I've got 100,000 to pay a $50,000 debt, I'm very comfortable. And I don't care what the ratio is, but 50,000 is good padding.
Right. So, but anyway, I wanted to throw that one out there because you may see it.
Good. No, and you see that a lot. I think all three of these numbers are numbers that appear on bank forms that I have seen.
Well, another one, going back to that initial debt coverage ratio that's on line 12, is that some of the banks actually, they may have that in their loan covenants. What we should be shooting for. So anyway, okay. Now let's go and talk about what's in column E and F. Okay, I got two different producers here. They both have the same income. A lot of their financials are what's available. It's 50,000 all the way across. Okay. But what's going on is that they have different, the way they're structured, they have different debt repayments that they're making. One's making 40,000 and the other one is making 10,000. So that debt coverage ratio is 1.25 in the column E, and it's 5 in column F. But what some of the banks like to do, or Farm Credit, they like to look at, well, if what's that ratio after we make our I'm going to call it the unfinanced replacement of our equipment. So if we're in the deal where we go and we buy that tractor, you know, the one guy he's going to put $2,000 down on the tractor, and the other guy is going to buy, he's going to put $25,000 down. So what's the impact of that when you look at his ratios? Because they're looking at how much how much capital expenditures are we doing every year? And so there's a piece of that depending on how aggressive sometimes we get on our capital expenditures. You can see where that can eat into that. We went from 5 down to 1.43. We're still not bad, but we dropped on the other one where it was 1.25. We dropped down below the 1.25. So, but this is just another way that the people that are doing extending the credit, they want to that this is what they're watching internally when they analyze, say, Grant Harder's financial statement. I'm just picking on Grant. Okay, so okay. Now, any questions on?
Yeah, let's clarify that. So the difference in the debt repayment here, where the interest is the same, is we're basically assuming, in my mind, that if you imagine all other things being equal, the amount financed is the same. The repayment terms is where the difference is here. Okay, and in the example you gave with the different down payments, what is the sort of how do we either adjust that, or how do we sort of penalize that appropriately for the fact that we are we were able to do a 0 down deal or something like that, right? That's kind of where you're going with that.
That's right. Well,
Right.
And then the other piece of it, you can see that the ones that are in the bottom 20%, they're struggling. Okay.
Yeah.
And then the ones that are in the middle of the pack, it's not real robust there when you go through that. But then when you get into the ones that are these are 10-year numbers, they're it gets up 2.7. So that's real strong.
Yeah.
Okay. So now let's
hang on just a sec. Let's see if we have any questions there. Any thoughts or questions on that? Okay, roll on.
Okay. And the last one is, well, some look at this as the alternative, but there's a lot of ag credit that they leave the operating line of credit interest in the analysis. So here, I just made that the most of there was really $5,000 worth of line of credit interest in there, et cetera. But anyway, where does that ratio shake out when you look at if you look at it just term debt to term debt? Because really that when you see a lot of you know, the ABIDA analysis that we went through a bit, you know, they're always taking, well, how much is that earnings before interest, taxes, depreciation do we have to have in order to pay debt? So that's a, I mean, this is a very, you know, the bankers do a lot of analysis with that. And this one, it was really only, that's only 6% better, et cetera. So what we're looking at there is this is not a real, it's not a real strong coverage. So, you know, they would need to either have some extra working capital or they're going to have to put something else up. But you can see that when you look at the, you know, where the middle 20, you know, the middle is and where the strong ones were, you know, in the, you know, you can see that there's quite a range there. But those are 10-year numbers. So, okay.
Very good.
Okay.
Okay, so I want to clarify one thing. You've mentioned ABIDA a couple of times, and I meant to interrupt you when you said it. In our P&Ls, the way that you'll notice that at the bottom, there is usually a net operating income line, and then there's some stuff underneath that, and then
Right.
there's the net income line. Your P&L is largely set up to be, if you get it through us, is largely set up to be that net operating income line is the ABIDA number.
Right, correct.
And then we put the taxes, depreciation, amortization below that number. So then the second number is the, I guess, what is the term for that, Walter? It's the non-ABIDA number is how some people refer to it, but
Right. Yeah.
it's the net income, right?
Yeah. I mean, really what you're doing on your operating one is that's really like the return to management.
Correct. That's right. And
Yeah.
And when one of the things that's interesting, so I had a conversation with Clay Conry on the Working Cows podcast about, you know, building assets in your operation and making sure you're doing that at the correct speed and at the correct pace. And I mentioned a number of times that it ties very closely to cash flow and your ability, in my mind, to service the expense of that asset. The expense of many assets is often debt. And so when we know what our numbers are, then we have the ability to say, okay, what can I take on? So in the case of column D, you know, we have not built any room in that business to take on more assets. As we've moved, let's say, you know, we get to Smith, we have created some room. I'm not really that comfortable there. If Smith got to a number that was 2.5 or better, now in my mind, we actually have the ability to use long-term debt to acquire assets. Is that a reasonable statement, Walter?
Well, right.
So when you are a very small business and you begin climbing that asset ladder, you are doing it in pretty small increments. As you get older and more experienced and you push that gap larger and larger, you now have the cash flow to service debt. Alan Nations has written a lot about that, and I think is one of the best that I've read, you know, one of the clearest and best thinkers on this. But one of the things he talked about that was fascinating is the idea that you own some land, but you lease a lot of land around there, and that in order to buy and to pay for land, you often are doing it with income off of owned and leased land.
That's correct.
And what he is doing by doing that is making that spread or making the debt coverage ratio bigger.
Correct.
Right? He is giving himself more income to service that debt. And you can imagine a scenario where over time you retire some of that debt. Now you can take on more. Over time, you can build that land asset to something that is very substantial, but you always want to be financed on the right amount.
That's correct. Yep.
Right. Because if you do not do that, and this is where we get to the running before we walk, if we get overcommitted on these things, that will drive you into a hole really fast. And I mentioned at the beginning of this that I'm very practical and I want to know what the dollar numbers are. Do I have the money to make the payment? And in any kind of situation where we are building our asset base, the most important thing we can keep track of is, can we make the payment?
Yeah, and that's what this does.
Yeah.
Let
Very
me,
clearly. I mean, this does it in a way in my mind that is, I literally can look below your debt coverage ratio at those dollar numbers, and I can say, what, this is like going to the used car lot. What can I afford to pay?
let me make a comment. I'm just to clarify a little bit. Okay, John. If we were looking at how your P&Ls are set up, John, you with me?
Mm-hmm.
What would be the net accrual income that we would have at the bottom line when we were starting through this process?
It would be the net operating income number, basically minus whatever we've credited you for wages.
Yeah, but well, I think it would be 25,000 because you're going to have.
Oh, you mean in what you've presented here? Correct. Yes.
Right.
Because we've already done the subtractions that you're doing here.
That's correct.
Right.
That's the point. That's the point I want to make.
Yeah.
Okay.
So here's what you can literally do, which is add up all of your payments that you make and subtract them from that number on the bottom right-hand side of your P&L. And that gives you the number in dollars of what's your freeboard there, right? What do you have? If you do it as a division problem, it will give you the ratio. But if you say, look, I want to be at a ratio that's at least 1.5 to 2, and let's just use 2 as an easy number. I want that to be at least 2. Then if the number on the bottom right-hand side of my P&L is 2 times my total payments, then I'm in great shape. And when it grows to bigger than that, I could add more debt.
All right.
And I want to make sure I'm doing this in kind of an average year, if that makes sense.
Yeah.
So if this is the best year I've ever had, I don't want to max that number out.
That's very, very good comment. Very good comment.
And I am not uncomfortable going from heavy into the green back into the yellow a touch, and then working my way back into the green.
That's correct.
Right.
Yep.
There's going to be a little dynamism.
Yep.
So if my threshold to get, sorry, Walter, if my threshold to get into the green is 1.75, I'm not doing it at 1.75. I'm building some padding first. Okay. Sorry, I interrupted you.
Well, really, when you look at this, when you look at the 25,000 that was actually in the hole, that's not. There's some other issues here, okay? Because we didn't really get a positive return on our assets.
Right.
Okay, so so this is one of those things we want to dig deeper.
Right.
In when we're trying to work with this particular client as an example.
Yeah, and I'm afraid we see that a lot where the assets are underperforming.
Right.
And this is a place where I know I harp on this a lot, but I love Kiyosaki's definition of asset. Asset puts cash in your pocket. It doesn't take cash out. And,
right.
This deal right here makes it real clear why. Because again, somebody's got to make the payment. And oftentimes making the payment is one of the biggest risks of debt and is a big risk of asset accumulation. You don't have to have debt on cows to know that they take money out of your pocket on a regular basis, right? Before you get to them producing cash.
Yeah. So
and that's an important thing to think about. And real estate is worse, right? Real estate is picking constantly, whether you have debt on it or not. It costs money to keep those things, and that cost to keep is very, very important that we are able to cover that. We had a great discussion the other day on ranching.fyi about hedging. And one of the discussions we had was about margin calls. And I think margin calls are a fantastic illustration for the larger problem of managing ourselves and managing assets in the world, which is you have to pay, as the market is changing, you often have to pay to stay in the game. And if in a margin call situation, you are often forced out. If you can't make the payment, you are forced out at the worst possible time.
Right.
One of the reasons why these ratios and the padding is so important is because they keep us from having our hand forced. Because oftentimes if drought or markets or weather or personal circumstances force our hand, we are almost always doing that at the worst possible time.
Right.
Quick example that happened to me early in my career. I worked for a very large ranch that was stocked to the gills. The plan was to adjust the stocking rate very aggressively in response to weather. 2002, we had a fantastic drought. Markets were also bad. We needed to destock at the worst possible time in the market. We chose not to try not to do that at the time. It caused irreparable, harm. I shouldn't say irreparable. It caused, I'll just say, harm that was expensive to fix in the future. And so this is a case kind of like doing oil changes on your truck. When you have the ability to do those regularly, you don't have any problems. As soon as you get behind or upside down on those things, then there's the immediate problem that confronts you, but then often there are 2 or 3 sort of unexpected consequences that linger behind the immediate problem. And that's where things spiral down fast.
So, okay, but John, I think that's all I wanted to go over today. Okay.
Okay, I've got one other thing I want to add to this. You mentioned working capital a number of times, which is our ability to service short-term debt. And this kind of like direct costs and overheads, to my mind, there's an interaction between them. The ability to service debt overall is very important. We break that into a long-term piece and a short-term piece. There, in some cases, you can be a little off on one and make up for it in the other. Just like I can have a ranch that might have low overheads but high kind of direct costs, or I could have low direct costs and high overheads.
Hmm.
What I don't want to be is in the position where I have high direct costs and high overheads.
That's
I don't
correct.
want to be really skinny on my working capital and really bad in my debt coverage ratio. I can buffer one with the other a little bit. We want to make sure that we are looking at both of them, even though we've gone through them here in isolation.
Well, I mean, I think if we go and we look at, we go to that, say, whoops, excuse me.
You're right.
Yeah, but when we look at some of the measures of the working capital divided by the debt service,
Right.
that kind of pops out. So.
Yeah, I agree with that. And again, I hesitate with the ratio, but I love the concept of that the two of those kind of balance against each other a little bit.
Yeah. Yep. You want it working forward. You want it working for you so that it's helping your resilience to stay in the game.
That's right.
Oh, okay.
Love it. Any questions?
I've got a question. You were talking about Kiyosaki and assets and stuff and putting money in your pocket. But what and maybe I'm missing the whole point, but where does retained earnings, or I mean, say you have a set of heifers out there that are growing and they're getting bred and they're going up in value, but you've not captured that. You haven't put it in your pocket yet.
Right. I mean, that's one of the things that you got to make sure. I mean, part of that, you're going to pick some of that up, Wally, when those heifers put those calves on the ground. Plus, you're gonna pick it out, even though you haven't sold them. You're going to be. I mean, and that's the whole beauty about doing your inventories each year.
Well,
okay.
Okay.
So you're gonna pick some of it up, maybe not all of it.
But let me go back to that point because it's a very good one. Now, one of my initial resistance to your cow appreciation problem was always a concern about cash flow. If I have these heifers and I am not able to pay my bills to get them to the time when I can sell them and capitalize on them, I'm in trouble.
Right.
Would you agree with that, Wally?
Now, I will completely agree, you know, there.
If I
Goes
can't
back-
pay the pasture bill or pay the
Yeah,
pump
well,
to
it's
keep
just,
the
it
water
goes
on,
back
or-
to keeping the heifers and breeding them is a good economic deal. But financially, it kills you. So it's not,
it
you know,
can't. That's
Yeah.
right. Now, here's the thing, your cow appreciation model and the sort of management system that we talked about last month in our sell buy system, what we often see is that if we do it right, the cash flow is not a problem. And that's the place where your model, in my mind, deviates significantly from a grass-fed beef enterprise, as an example, because the grass-fed beef enterprise is not a profit increase that is correlated with a cash flow increase. It is a profit increase, maybe, that is often correlated with a significant cash flow and turnover decrease. And that in my mind is a huge difference between those two business models.
well, to me, and I'm a very simple person, but you know, when you can make the, you know, heifer calf into a bred heifer, and you spin off and you get $400 or $500 or $600 in cash plus you know, the amount of money to carry that heifer, you know, that's where your cash flow's coming from. And what gets them on the other side when they're talking about the 8-year-old cow, the depreciation is eating up so much of that calf value that when you put the cost to carry on, there's nothing left.
Right. Right.
But I also have the cash flow coming from the sale of my 5-year-old cows.
Yeah, no, that's what I'm saying.
So-
Yes.
So again, if I start from scratch and all I do is go buy a bunch of heifer calves and put a bull with them, I could get myself in a very heavy cash flow bind right out the gate.
That is absolutely correct. Just like right now, I just talked to a gentleman today. He's talking about breeding a bunch of heifers. And I said, well, you better do the numbers because, you know, it's a long ways to, you know, it's a long ways to the end out there.
Yep. Okay. The other thing to think about in all of this, I think, is the structure of our debt. Because again, when we're pragmatic and we think about the payments, and if we have some ability to choose what our payback date is, in my mind, if our payment is correlated or you know, highly related to when the cash is coming in, then that does not create a cash flow problem. One thing Doug Ferguson talks about is financing calves through feed yards as you're feeding them. And one of the reasons why that often works very well is because the bill comes due at the same time the cash comes in. We can debate the merits of that all you want, but the biggest thing is I don't have to come up with, you know, $20,000 a month to keep shoveling into this system to get to a $200,000 payoff sometime in the future. So anytime we can structure our debt so that the repayment and the cash flow are, you know, in sync with each other, it makes our lives a lot easier.
You know what that's called, don't you, Haskell?
Which part?
Of structuring it so the debt comes due when you got sales, and that is a Sam Walton.
That's exactly right.
You know, I'll pay you for it right after I've sold it.
Yep.
Right.
The ultimate sell buy. You actually buy the inventory right after you sell it, but he does it in time.
Yep.
Very good. All right. Any other questions on this or comments?
Well, I've enjoyed helping your team and your participants today, John. So okay.
Well, I really enjoy having you. I made a social media post here recently that I think is, if it hasn't come out yet, it'll be coming out soon. But I have, you know, been asked a number of times to talk about debt in public, and it's always something that makes me a little uncomfortable because there is a lot of nuance to it. I think generally in agriculture we have a terrible relationship with debt. primarily because we use it for things we shouldn't, and we don't have enough understanding to be able to use it properly. I think putting yourself in a position where you can understand what, sort of where you are with regards to it and what is possible. And if you are using it to drive a highly profitable business, it can be very effective. If you are using it to sort of cover your sins and that sort of thing, it can really come out and bite you. One of the hardest things to deal with in the world of debt is momentum.
Right.
And I often worry that most of the time we are aware of a problem or aware of what the situation is, we're often 2 years late. And that you're waiting under the tidal wave. The wave's built, and our ability to sort of fix it at that point it's rough. People who talk about debt a lot talk about accumulating the past and bringing it into the present. I think that's an interesting thing to think about. Again, I think Alan Nation does a great job of talking about and thinking about how to sort of make those things work. There's no doubt. I think the simplest statement is debt is a very powerful tool. Sometimes it is the powerful tool that we use to get ahead, and sometimes it beats us. And when it beats us, it's rough. This is a stick I don't like to get hit with very often.
Right.
So I think, again, we're happy with the folks we work with to, go through these numbers. These numbers are very simple, and there's not a lot of room for interpretation. We're either in the green or we're in the red, and we need to get ourselves into the green as quickly as we can.
Okay. Thank you.
Thank you, guys. Appreciate you coming, and we will be back again in a month. Walter, have we debated what the topic next month is going to be?
No, we haven't yet. So.
Okay. Well, I'll get that out between now and then. So you guys all have a wonderful afternoon. Thank you for joining us, and we'll talk.
Pascal, stay on a minute. What are we doing?